Hello guys, welcome to my YouTube channel again, and today we are going to discuss a very important strategy in options. If you don't know this strategy, then you are really missing out. This is a strategy that can generate you consistent income week over week or month over month. So if you are interested to know more about this strategy, then stick around. We are going to discuss this in complete detail. Okay, before we go to the wheel strategy, let's do a quick recap of the pillars of options strategy, right? Because if you understand these pillars well, then it would be very easy for you to understand the how the wheel strategy actually works. So let's see these four pillars as I say, right, in options. So the first is a buy call, right? So this is a simply right to buy 100 shares of stock at the strike price. That's the very simple buying a call in options, right? The other way is buying a put, right? So this is again a reverse of a buy call, right? You right to sell 100 shares of stock at the stock price, right? So this is on the buy side of it, right? But on the wheel, the more important things that we have to understand is the sell side of it, right? So these two are very important to understand. So what is selling a call, right? So selling a call is like you are obligated to sell 100 shares of stock at the strike price. That's the definition of selling a call. This is so for any trade, right, there are two parties, a buyer and a seller. So if someone is buying a call, definitely there is has to be a party which is selling the call, right? So that's the selling of call. So if you are on the seller side, you are obligated, remember, you are obligated to sell 100 shares of stock. Okay, no matter what, you are obligated to sell those stocks. Same way for if you are doing a put seller, then you are obligated to buy 100 share of stock, right? So you are obligated to buy 100 shares. So this is again compared to the buying a put, there is someone who is selling the stock and you as a seller is obligated to buy the stock, right? Okay, so now that you understand these four pillars, right, let's dive right into the wheel strategy. Okay, so what is wheel strategy? Right, on the definition of the wheel strategy, the simple definition is buy low and sell high. It is a strategy where you buy a stock at a lower price and sell it at a higher price, right? The second point is how the cycle works in a wheel, right? Why do we call this a wheel, right? So because it is a cycle, it is made up of two steps. The first step is selling a put and the second step is selling a call, right? So these are the two steps on which wheel strategy is built on. So you start with selling a put and then you ends the wheel with a selling a call, and that wheel keep turning on. Once we go into the example, this will get more clear. So just hold on for a second, and then once we go into a deep example, right, it will become more clear. So just understand this is made up of two cycles, selling a put and then selling a call. That basically makes the wheel strategy, right? And the third point is very important for the wheel strategy is you have to do it on a stock that you really want to own. Okay, never do it on a stock that you do not want to own. Okay, so this is a flow chart of the wheel strategy, and I think if you understand this, then you can really get the crux of how the wheel works, right? So it starts with like I said, right, it starts with selling a cash secured put, right? So that is the very first step that you do, and then you wait, right? Then you see at the expiry what is the stock moment. Did it go up, did it go down? So if the stock moves higher than your strike price, then you are all good. Or if it's just same, then you are good. You just do this cash secured put again. So this is a loop, right? So you set a strike price. If the stock goes out of the money from your strike price, it ends up higher than your strike price, you just do it again for another a further expiry date, right? So this goes on, and until when this goes on is basically, if the stock price goes down from your strike price, that's where the stock would be assigned. Remember we said you are as a put seller, because you are selling a put here, right? So as a put seller, you are obligated to buy the stock. So if the stock goes down, that is it's now the stock is in the money, right? So you have to buy the 100 shares of stock. So once the stocks are assigned, now this is the, so the first part of the wheel ends here, right? That's the first part of the wheel. Now once the stocks are assigned, right, that's where the second part of the wheel starts. So now what you do, you start doing selling a covered calls, right? So that's the second part. So you sell the covered call at a you can do at the money, or you can go a little higher in the strike price. Let's say you were assigned 100 shares at a price of $100, right? So you sell a covered call for $110, right? So that's how you sell the covered call. Now again here there is, if you see, there is a loop. So you sell a covered call, right? But if the stock ends up being lower than your strike price, because you are on the call side, right? So if the stock ends up being lower than your strike price, then you keep your 100 shares plus you collect the premium as well, right? So, and this loop goes on until you are actually if the stock moves higher than your strike price. So if the stock moves higher, that's where you are forced to sell the stock. Remember, you are a seller, so you are obligated to sell your stocks. But all this while, there's one thing which is common, right? You keep collecting premium, and that is the magic of wheel strategy, right? You keep collecting premium, whether you do here, whether you are assigned, whether you sell covered call, whether your stocks are called away from you. In all these cases, you keep collecting premium over and over again, right? And that is your consistent income. You do it monthly, you generate monthly income, right? So that's the flow of wheel strategy. Now let's go to a concrete example to make it crystal clear on how you can actually execute this strategy. Okay, time for a good concrete example. So I'm taking Apple as a pick for the wheel strategy, but you can pick any of the stock that you want to own. Recently, Apple dropped after the earnings, and this may be a good time to start wheeling on Apple. So that's why I'm just taking Apple, but it's applicable for any other stock. So let's go to my Robinhood account and then actually see how you can do it. So we are basically, the first step is we are going to sell a put on Apple, and the current price is around 181, and we'll set a strike price as 180. Expiry, we are going a month ahead, so we'll just pick expiry of 15th September. Premium is 410. I actually before recording I did check what is the premium going on for the 15th September, so that's why I have given here 15th September. Okay, so we are in my Robinhood account, and let's open the position. So we search for Apple and we trade options, and remember the first step was sell put, right? So we select sell here, put here, and for expiry date we go September 15th, sorry about that. And then on the strike price we say 180, right? So this is the one that and for opening this position we are going to receive 410 uh, dollars, right? So as you can see here, right, the max profit that you are going to get to open this is 410. And because it is we are opening for 180, right, 180 strike price, and one contract is equal to 100 stocks, right? So you have to have $18,000 as a collateral that you need to keep. That's why it is called a cash secured put, right? So that's why we call this cash secured put. So you need to have $18,000 to open this, and this is the first step of that. Okay, so the next step is right, what happens on the day of expiry, right? 15 September, the day of expiry. What really happens on this? So that's what we're going to look at now. So right, what happens here on this date? So there are three cases that can happen, right? Case A is, if Apple closes above your strike price, which is $180, right? So this is the happy case for you, right? Because it is expired out of the money, so you get to keep the complete premium, and then you sell another put. Now let's check the second case. So what happens in this scenario if Apple is equal to 180, right? So this is uh, exactly ending at 180 is kind of hard, but let's say that it does end up at like exactly closes at 180, right? So in this case as well, you are safe, because in 99% of the cases, the buyer of this option, right, they will not going to exercise, because think from their perspective, because they had to buy when they bought this contract, right? Contract, they had to pay a premium which you received, right? And they are already, their break even is somewhere above this, so their break even could be around 182 or $183, right? So they will never exercise at exactly at 180. So this contract is going to expire worthless, and you get to keep the complete premium. So that's the case 2, right? Now is the interesting one, right? Case third. In this case, let's say the Apple drops on the expiry, the Apple drops below 180, right? What happens in this case? So this is where the wheel reverses. So because remember, you are obligated by the contract to buy the stocks at your strike price, right? So in this case, because it ended up below 180, you are obligated to buy the stock. So let's say, going back to here, right, let's say it ends up at 175, right? So you have to buy the stock at 180 only, even though the current stock price is 175, right? So you, because you signed the contract and you are bound by the contract and obligated to buy the stock, so you buy the stock, Apple stock at 180. So that's where the second leg starts, right? So now you have 100 shares of Apple in your account, and now let's look at what happens next. By the way, guys, if you like the presentation and the video so far, please do like uh, the video, and do consider subscribing. There are going to be a lot of informative videos coming in soon, right? So let's look at the scenario here. Okay, so now that you have 100 shares of stock, what you're going to do next, right? So that's the next step in the wheel. So you have 100 shares of stock. So now you turn the wheel, you start selling covered call. So you sell call on Apple with expiry date of, let's say you got assigned in September, right? So you sell something for October, right? And then collect the premium, because you get to collect the premium either ways. So in this case, let's say you sell a call, right, for October, and you select a strike price 185, right? So you sell this call, right, and you get to collect this $680 as a premium, because you are agreeing to sell Apple stock at 185. So for that you are getting this premium. So that is the beauty of that, right? So you again collecting the premium. Now let's move on to the scenario on the covered call cases, right? So let's say on the expiry date of October, what happens in this case? So uh, if Apple closes below 180 because you sold a contract for say 185, right, and it ended up only till 180, which is below your strike price, you get to keep the premium and you again sell a covered call for the next month, right? And you, because you still own the share of Apple. The second case is exactly at 180. Again, the same thing applies what I explained before, right? If it happens to be 180, the buyer of this contract will most likely 99% of the cases they will not exercise, right? Unless they have a very bullish outlook on the stock and they think that it's better to exercise and then use and they are expecting the stock to move further higher from there, right? So in only that cases they are going to exercise this, otherwise they are not going to exercise this contract. So you get to keep the premium and you still own the 100 shares, right? Now this is the case 3. The stock moves higher from your strike price. You set a strike price as 180, but stock at the time of expiry, the stock is, let's say, 185, right? So in that case, remember, you are obligated to sell your stock at the strike price, right? So you have to sell your stock at the strike price which you selected, right? Okay, so once you sell your stock, you will get your money back, right? Say $18,000, you will get it back. So you restart the wheel, right? So again, you start from where you started in the beginning, right? So you start again here. You again start selling the put. So you see now that this is a wheel. So this is again you are going to collect premium, and you do this until you get assigned the shares. Once you are assigned the shares, you again do covered call, and you do covered call until your stocks are called away. So this is a loop that goes in again and again, and you get to collect the premium every time that you do it, right? Let's just summarize the overall what we discussed so far. So there's the key points are it is a win-win strategy, as you saw, right? You anyway wanted to own Apple stock, you have and you wanted at a desired price. So that is one of the key factor of a wheel strategy, right? So it's a win-win strategy. Second point is the consistent premium payment, right? You are consistently getting premium. Your stocks is not sitting ideal, because in a buy and hold case, right, if you had just holding on to Apple stock, it's not going to give you anything, right? But in this case, it is giving you consistent income every month, right? Just for rotating the stocks, you sell cash secured put, you sell covered call, you just rotate it and collect the income, right? The third point is as I mentioned before, always do a wheel on a stock that you really want to own, right? Because if you never wanted to own that stock, and if you end up getting assigned on that, you have to bag hold that stock, right? So, and another last point is consider getting into a wheel strategy for a stock which is less volatile, because if it is highly volatile and there's a erratic movement, it would be difficult to manage your position in a wheel, right? If it goes too way below your strike price, it's difficult to get a good premium for the covered call. Other way also is like, if there'll be lot of at every expiry you have to decide, and it would becomes difficult to manage the position. So always pick a stock which is less volatile. Okay, so I think that's about it on the wheel strategy. I hope you liked the video. If you have any questions related to wheel strategy, please do put in your comments, and again guys, please do like, subscribe. I'm going to put more videos around this strategy, maybe some other examples that I have, and there are what are the other risks that you may have. So I'm going to put lot more videos around this strategy. It is a wonderful strategy if you are options trader. So that's about it, guys. Thank you, and I will talk to you in my next video.